Hi everyone, welcome to Keystone Academia. This is Nihala Nazir. I'm an ACCA finalist and I have been teaching for 2 years now. Today, the topic we are going to cover is from financial reporting, which is one among the 6 papers you got to attend in skill module. FR has its majority of portions covering the IAS and IFRS. Briefly described, IAS and IFRS are the rules and regulations according to which you prepare your accounting records. So, today we are going to look into IAS 16, property, plant and equipment. So, to define an asset in property, plant and equipment, it should be used in production or supply of goods or services or for rental to others or for administrative purposes. And point number 2, these are expected to be used during more than one period. So, point 1 signifies that this asset you're talking about is used in production, okay, or you have been using it for rental purposes, or you have been using it for your administrative purposes for your business. The second point here mentions that it should be used for more than one period. So in business, more than one period basically means that it should be used for more than one financial year. So in every IAS and IFRS, there are certain recognition criteria according to which you group your assets in the respective standards. So here the recognition criteria of IAS 16 is, first one, probable future economic benefits. So this basically means that the asset in question should bring you future economic benefits, okay, associated with the asset. Okay, so that means it should bring you cash flows or profits or any other type of benefits in the future and should be in economic in nature. So the second condition is that it should be cost reliable. So that means the asset you're talking about should be should have a cost that can be reliably measured. So coming to its measurement, there are two types of measurement you make for an asset. One is the initial measurement and the other is the year-end measurement. So the initial measurement, you actually have to include all the costs that you incurred while purchasing the asset. So the first one is cost incurred on purchase. Okay, so purchase price or built-in price. Okay, so the second cost is that every other cost that is directly attributable to the asset so that it is arrived in its working conditions. All the attributable amounts to make the asset working. So if you consider the purchase price, then the cost is going to be the purchase price, okay, plus the import duty if you have any, minus trade discounts if you have got any, and plus the directly attributable amounts, and also and lastly the dismantling cost. So the dismantling cost is basically the cost that you incur on the after you have used the asset to its maximum level. So after you use an asset to its maximum, what you do is you dispose the assets off, or in order for you to dispose the asset, you may have some extra cost in the future. So all those costs which you incur so that you can dispose of the asset is called the dismantling cost. And here something to be noted is what the cost you have is probably a future value cost. Say if you have acquired an asset worth $10,000 and in 3 years the asset is going to cost you $8,000 for its dismantling. So that means this 8,000 is probably an estimate that you have found in future. So it is important that you convert this into your PV, that is present value, using the method of discounting. So in order to discount your product, you use 1 by 1 plus R raised to N. So the whole cost you get while you add and subtract these contents is the cost of the asset that you are going to mention as your initial recognition. coming on to the year-end recognition. So, in the year-end, you can have two of these methods to measure your asset. First one is the cost model, okay, and the second one is the revaluation model. So, under the cost model, you have your assets costs, okay, the cost I mentioned just now. So, you have the asset cost and the accumulated depreciation that you have on that asset. Depreciation is the value of wear and tear you mention or you should recognize while you purchase a non-current asset. So, this is going to be your carrying value for the year end. Also, to quote, depreciation has its three types, okay. Number one is the straight line method. The second one is the reducing balance method. And the third one is the measuring hours method. So it is completely for the accountant to reason out which depreciation method he is going to use, okay. So if you are opting for revaluation method, okay, you consider the market value or fair value of the asset, okay, market or fair value of the asset. In order for you to group it or for you to measure it under revaluation model, there are certain conditions that should be satisfied, and the conditions are, first one is reliable fair value. Reliable fair value should be available. So if you are considering an asset to be valued under revaluation model, you should have to have an estimate regarding its fair value. Second one is, if you have grouped one asset as to be measured in revaluation model, then all the other asset that includes in that very group should be measured under revaluation model only. You can't have two choices for the same group of assets. So all the assets in the same class should be revalued and at the same date using the same measurement model. Okay. Now, this revaluation you have used is continually done during every accounting year. So, you do not have an option to skip an accounting year. You do not have an option to change the revaluation model unless it is very reasonable and it is very genuine. So, the third one is continually done each accounting year. So, while you revalue your asset, there are cases where you will have your carrying value will be more than the revaluation. So in that case, you get a revaluation loss. And if the carrying value is less than what you have revalued, then you get revaluation gain. And this revaluation gain or loss is taken to the OCI of the SOPL. And that's for the class today. I hope you have understood the topic very well, and I wish to see you soon. Bye-bye.